All right. Welcome. On behalf of Terra Equity Group, I'd like to welcome you to our presentation today with, I have five panelists with me here. I have Vino, I have Karan, I have Raj, and today we're going to be discussing our newest fund, Terra Capital Income Fund 2, that we are happy to launch. I'm going to talk about it and what it has to offer, and we'll discuss and answer a lot of the questions, and we want to thank you for joining us today. So, with that being said, and further ado, let's get started. This fund that we're presenting, fund number 2, it's a little bit different. This consists of, uh, we're going after distressed properties and opportunistic properties, especially in times like this where there's a lot of opportunity out there as the markets have been turning, and that presents itself with opportunities that are too good to be passed up upon, and that is the essence of why we have the inception of this fund. So we can get to the next slide. We have your disclosures here in regards to any investments that you do make. We recommend you reach out to your tax advisors and your legal counsel, and to understand all the risk associated with that. Talk about the investment summary and highlights, and then the table of contents is here, offering specifics, who we are, how what we have to offer as Terra Equity Group in regards to our track record. Why do we like this fund? So we're going to get into all of this, and certainly what the critical dates are and the next steps for you as an investor if you should choose to come on board. All right, Karan, take it away.
All right, so to give everybody a little summary and a highlight of the fund. So like Puneet mentioned, we're going to be targeting distressed properties. It's highly beneficial for us to do so just because they're available at a significant discount compared to their market value. We're going to have two different investment groups, and we're going to go more in depth on what those are in the next couple slides. We want to diversify across different classes. We want to have, a variety of different classes. That way we can minimize risk and reduce the exposure for our investors. The overall goal for the fund is to purchase around 6 to 12 different properties or different assets. And we want to execute that over a 5 to 7 year plan, hold it, and then exit after we add that value. We're going to get into a little bit about how our team is well-versed in finding these opportunities. We do so from professional servicers, auctions, and then as well as our relationships that we have with the brokers and lenders. So it's going to be a $100 million 506c fund that's open to accredited investors only. And we're going to be using the expertise of our senior management, especially their expertise in the investment world, property management, and asset management. So if we go to the next slide, this is just, again, just a little overview of the offering details. Like I mentioned a little bit earlier in the past slide, it is a 506c regulated distressed fund. We're going to be accepting, again, only from accredited investors. Minimum investment is $100,000, and we're expecting around 5 to 7 years. So we're going to be using a tiered equity structure. So the Terra Capital Fund 2 has two tiers of investors. You have the Class A1 limited partner and the Class A2 limited partner. The way that the breakdown is that you have an option to invest in either or, and the return is different depending upon the tier that you're in. So the Class A1 partners get a 12% preferred return, and it is a first priority directly behind the senior debt. And then the Class A2 is a 8% preferred return, along with participation in the upside of the assets. So if we go to the next slide. So again, just to give you a little bit more information about what we're expecting to see over here. So the Class A1, again, these are the higher priority investors. It is a 12% preferred return. Again, there's limited upside upon disposition. You're basically in the Class A1 tier going for strong early year cash flows. You're going for less risk. You're not waiting for the end cycle to kind of see the return that you get. The Class A2 limited partners is a 8% preferred return, but you also participate in the profit upon disposition of the property. And the split that we're going to see over there is going to be with the general partners and the limited partners. So the Class A2 limited partners will get a percentage of the asset gain essentially that we have. And then they'll get their preferred return up until they hit a certain annualized rate of return. This type of class is really for investors who are seeking to maximize their return. But they're okay with the little lighter, earlier cash flow. And again, it does come with a little higher risk compared to the class A1. So you have, just to summarize, you have the class A1 partners. Those are the ones with less risk, higher cash flow up front. And then you have the class A2 partners, which is a little bit more risk, but again, you get a cut of the pie upon disposition. So it tends to lead towards a higher return, but again, it does come with a little bit more risk. So again, this is kind of giving you a breakdown of the A2 projected return. So that's that early year, shorter cash flow. Now I'm going to hand it off to Viraj.
Before we get into that, Karan, I like to kind of have Vino chime in. He is our CEO and founder of the firm. And Vino, I know this is your brainchild, and you have been through a lot of these downturns in the economy, especially the dot-com boom and bust and the 2008 and 2009 downturn, and then more recently COVID, and now we're headed towards what seems to be in this recessionary cycle in the capital markets and inflation, and plagued by all sorts of things that are happening, which some can view as doom and gloom, and others can view it as an opportunity. I think you're one of the other, that sit on the other side where you see this as a great opportunity. So talk to us a little bit from your experience as to why you see this as an opportunity or opportunistic time frame for these type of assets. And in terms of the inception of this fund, what are your goals and aspirations, and what would you like to see as the end outcome once it's all said and done from this fund?
Well, like you mentioned, 2008, 2009, and 10, what happens is everybody gets panic, including lenders, borrowers, the property owners. Everybody is just trying to find out what they can do. For our fund, so in 2010, 2009, 11, what we did, we bought a lot of mortgages. We resold them. We got a discounted property values from the lenders. We got a discounted property values from the owners. They were just really struggling with the property. And that's created a huge upside on the properties, and plus the cash flow when the market start going up. So the same, philosophy here, that we feel that, in today's market, there's a lot of chaos exists today, and we can take advantage for our investors, and our investors can make high returns side by side with us. We can acquire properties from special services. We can acquire properties by different asset class. So we're not tied to one asset class, one property, and we're going after. We can buy bridge loans. We can give private loans to these people where the returns are high. So we try to, multitude of different options in this cycle where we can have a heavy returns for investors plus the cash flow.
So all great points there, and certainly appreciate you kind of bringing us the insights and the backstory to behind this fund and your experience. And I think Karan alluded to it a little bit in the previous slides, and you mentioned it as well. A lot of this it goes back and dates back to your experience and your relationships that you have curated being in this industry for over 25 plus years. So a lot of those come to fruition now. And can you just touch upon that on that piece as to how we can use that to our advantage in sourcing some of these deals? I know Karan kind of mentioned that on the previous slide that we have some relationship based with special servicers and of that nature, and I think you mentioned it too. But just touch upon that, because I think that's a key point as to behind the success of this fund, and I guess then in that sense, the inception of the fund, as we like to call it, the driving force. So, talk to us a little bit about that.
And the
those relationships.
Relationships comes through, through the hard market. Nobody wants to talk to you when market is hot. But, the brokers that you have developed a relationship in the past, and when they were in the tough time, they bring these kind of deals because, owners, they're not selling in open market because they don't want to be, facing the challenges, people coming out, going through their properties, watching it, and seeing what's going on, what the mess they have created. They don't want to reveal their secrets, that what happened by running that property. So what happens? They go to their trusted broker. The broker reaches out to the people they have done the deal before and say, hey, we have a deal here, we can make it. Maybe we're doing a short sale with the bank. Maybe they're taking less than what is owed on this thing. Maybe we're taking out the preferred equity providers, that they are taking less on this kind of market because they are scared with the property. And we analyze the market, the condition of the property and everything. And we can make a deal with the owners, we can lenders through the brokers, and it becomes a quick and easy because they are not you're not competing with anybody, and we love that side. When you're not competing, then you put the value that you feel that asset worth, and your investor is going to enjoy the heavy returns on those assets. Same thing goes with the lenders. We have built a lender relationship for the last 25 years where they come and look out for you. As a matter of fact, last week I had two lenders, they visited the properties. They have suggested me that say, hey, they're taking over the property. And if you are interested, they're just basically assigning or taking less and saying, take over the property. We know the value is there, but then you need a quick cash. You don't want to be going through financing, and eventually you will finance those properties, but you want to close quickly when these lenders come to you and ask for it. Once you close it, you can go out and refinance and do that, but that will create tremendous, extra capital or the value for our investors, for us, and the cash flow on those properties.
Perfect. So it goes in side by side, and I know you have a big philosophy, and you always speak, in regards to that is, in real estate, money's there to be made. How much money you make is very dependent upon on the cost basis of you getting into that particular transaction or that particular deal or that situation, right? Or that investment, so to speak. So as long as you're saying and highlighting these opportunistic or distressed properties, the time is right, and if you're getting in at a great cost basis, that return is going to be hefty on the other side. And like I like to correlate that to from, in the stock market, kind of the same. When the market is down and low, you buy low, and you're going to see some great results, right? And similarly, individuals who have a knee-jerk reaction when the market is turning and they exit prematurely are the only ones that end up losing in the long term. So, a lot of analogies here, but, in terms of what the markets are, but in real estate, the couple of things that I think, you have also mentioned, talk to us in how real estate can really help us in 3 or 4 different ways to a regular investor that comes on board. I know there's some hallmarks that you can really, touch upon with the real estate and hard assets. So just touch upon that, and then we can get moving on with the webinar and the other
Well,
aspects of it.
majority of people, they think that, we make money when we sell it, but there's a few that they think, we create value when we're buying, how good the buy is. For our investors, we make money by having a higher value. So buying low and selling high when the market is right, the value is creation, cash flow creation. And the top of that, real estates also provide the tax advantage for the people, so they can take advantage of the profits and shelter their profits through the, depreciation and cost segregation type of efforts that we make in our real estate properties.
So it's a hard asset. It's appreciation, forced appreciation in some of these um, mm, projects that we may be looking at, and also the depreciation aspect of it in terms of the tax savings that an individual can have or an investor can have when we partake in these bonus depreciations or accelerated depreciations with these assets and commercial assets. So all great points there. I certainly love the feedback and the reasoning and the theory behind the inception of this fund. So Viraj, if you can take it and talk a little bit about ultimately what Terra Equity Group is about, because when it's all said and done, I think the operator and the individuals behind who are running the machine will shed some great light into the success of these funds and these real estate investments. So talk to us a little bit about Terra Equity Group, and then we'll get into the nitty gritty of who's behind and what level of experience Terra Equity Group brings to the table.
Of course. So who is Terra Equity Group? Terra Equity Group is a fund, is a group that invests in multifamily and commercial real estate. We build better communities for our tenants, and we yield better returns for our investors. We have almost close to 2 decades of experience in commercial real estate syndication, focusing on multifamily. And we have about 4,300 plus units, close to almost 500 million assets under management across 7+ states. The reason or how we accumulate this vast portfolio is through a 5-step process. You know, we have our broker relations that are nurtured long-term with many broker partners across the country. We have our focus in emerging markets. We want to focus specifically on markets that are in the Southeast to make sure that, you know, our investments have room to grow based on long-term socioeconomic conditions. And also, we want to focus on the off-market multifamily assets, which through our broker relations, they offer us stuff that aren't listed publicly. And we get an opportunity for value creation, which is our 4th step, because you get these properties that have massive room for value add. And then that causes capital preservation. We're able to offer our investors 6 to 8% preferred returns on a monthly distribution. Next. So what are our values? How are we able to accomplish this? We like to focus on family, passion, and legacy. Family, because we treat our investors, tenants, and communities as if they're one of us. We want to make sure there's a lot of trust, there's good partnership, we're reliable, and there's a lot of security. And we also, as a group, we also happen to be a close-knit family. Second, we want to be we are very passionate towards capital preservation and creatively increasing the value of the real estate assets we enter, so that the communities that these apartments are in are better off for it, the tenants have a better place to live, and we can give our investors a better return. Third is a legacy. We want to leave a legacy for a really long time, and by approaching real estate and multifamily syndication in the right way, we hope to do that in the communities we build, in the relationships we have with our tenants, and our relationship with our investors. Now, a little bit about the individuals. We have a diverse group of individuals with a diverse real estate background. We have, you know, Vino Kulhari, our CEO, our founder, myself, Director of Acquisitions. We have Puneet, who's been talking, the Director of Asset Management. We have Karan, who's also been talking, Director of Acquisition. And then briefly, we'll go over Julio, who's our CFO, Sheena, our Asset Manager, and Georgette, who's our Assistant Operation Manager. And then as you go through this, you can go through the decades of experience that Vino Kulhari has. I have almost close to a decade myself. Coming in, Puneet and Karan also have been putting in the time and have been with us for, you know, building this group into what it is and the portfolio that it is. And obviously Julio, Sheena, and Georgette are, you know, more hands-on on the operational side of things, and Julio making sure things are good on the finances side. And next, I'd like to pass this off to Vino.
Well, again, this group is, you know, vertically integrated, where we do asset management, construction management, property management, all sort of fund management. So, you know, we are in-house, everything we do for these funds and these properties. We take care of great pride. We want to make sure our top priority is our investors win, and we create significant value and cash flow so they can enjoy side by side with us. In a commercial real estate asset class that we plan to, you know, invest through this fund is going to be multifamily, medical offices, retail, you know, hospitality. Could you do a next slide, please? Hospitality, bridge loans, you know, private short PE loans, private equity, and the short-term lending for the owners who are suffering, and we can able to take over either property or take a bigger chunk of their side of the share. So, you know, that's the plan is with this sector. We've been in this sector for the last 25 years or more, and really created a lot of values for our investors, for ourselves, and, you know, a lot of properties, they enjoy, you know, heavy capital gains and cash flows. Puneet, can you take it?
Yes. So a couple of things I think I'd like to kind of just summarize. I know we went through, you know, Raj talked about who's behind Terra Equity Group, and the, the people working to make this fund a success, and the past transactions and the track record, I think, speaks volume for itself. We've done a heck of a job of the projects that Vino's been part of, and kind of been in the driver's seat of, and certainly want to continue that path forward and that progress forward with the launch of this fund and what we have to bring to the table here. A lot of it has to do with the mindset that we have, and the values that we as a company possess, and want to carry forward, and the legacy and what have you. So with that being said, Vino spoke about much of the different ways, diversified methods or manner in which we want to apply the funds that we raise here, and the type of assets we want to invest in terms of the distressed assets. So distressed assets and opportunities present in various ways. Some of those highlighted in the types of different asset classes, but more particularly, we may also be very interested in providing equity as a preferred equity partner, or doing some short-term lending, because a lot of that is or a lot of the investors are in dire need of that now, as the market has turned and the interest rates are high and some of the bridge loans are coming due. So it creates a great opportunity for us to have that, and we would certainly be able to scoop up a lot of our interest, or a lot of properties or assets at very discounted prices, given where we are in the timeline of this economic cycle. So certainly bodes well for us and for the fund, and our methodology behind it is sound, and our approach is sound as well, which is going to go back to Vino's point of getting into these assets at a great cost basis, which is ultimately going to increase our equity, and in turn enhance our returns. So our philosophy, I'm going to touch upon that briefly. Math over emotion. Vino's been doing this for quite some time. Really, the numbers have to make sense before we get into anything. We don't get emotionally attached to any of the assets or any project unless the numbers make sense, right? Secondly, I think a big part of it, Raj mentioned the talent and the team focus. We have a very talented and a diverse team that has multitude of experience in the finances and real estate, from the capacity of that, and really looking and drilling into these numbers and these opportunities that present themselves. Thirdly, the distressed and the opportunistic real estate focus that we're going to be driving. And I've mentioned tons about that in terms of how those opportunities are going to present themselves in this market cycle, and how we will be able to take advantage of that and provide a great upside for investors who decide to join us. And then lastly, it's more about systems. As with anything else, if you have a great SOPs or standard operating procedures, you can ensure that the results are consistent, and that's what we've been able to deliver. We cross our T's and dot our I's to ensure that we are going to be able to make the returns that we're projecting for our investors, and we certainly feel very comfortable and confident. And a lot of it has to do with what our current portfolio looks like and our track record. We have almost 120 million in equity raised in the tenure of this company, Terra Equity Group. We have close to $500 million in assets under management, over 4,700 units that we own and manage across 19 states, across 19 properties and 8 states. So, and our track record speaks highly. We have a average annualized rate of return of 25%, 2.5 equity multiple, and preferred return, average preferred return of 8%. So now I'm going to kind of talk to Vino about why these distressed properties kind of make sense. I know we touched upon it, but we want to dig deeper, as this is the essence of why we started this fund, and basically the meat and potatoes of today's webinar. So Vino, walk us through your mindset, and I know you touched upon it in the beginning, but how we're going to provide value in this fund to our investors, and why distressed property.
And distressed market, that what we're looking at it this time right now, that everybody's going through crazy because media, inflation, interest rate is going high. And based on all those factors, we feel that some people, they're going to be end up losing their properties. And it's not that we, enjoying that people lose their property, but that's the market cycle. Maybe they didn't buy it right. Maybe they didn't manage it right. So, we come in to, take over those properties or manage those properties properly once we take over. Sometimes you get a 20 cents on a dollar. Sometimes you get a 25 cents on a dollar. But we buy these, we buy quick and then take it out and create the value on these properties based on what we have. One portion is that whatever was built, 5 years ago, is we can't build with the same price. So even if we're buying on the less than what is cost to build, I mean, it's just creating a value. And these are hard assets; they don't go anywhere. They are cash flowing assets. They have a tenants in there. So all these properties that we are going after is going to be very devalued as far as we're concerned, and we will be picking up them lower than what it was one point, and creating back the value that was lost because of the mismanagement or over financed or the market itself. So those are the properties that we're going after.
The slide real quick. So expertise, we talked about that. Risk mitigation, basically we're diversifying as we're going in various different types of assets. So, buying distressed properties, they come with their inherent risk, but the fact that we're diversifying it in with multitudes of asset classes within commercial real estate speaks volume. And also the type of, assets we're going after, or maybe even providing preferred equity and short-term lending, that it will also help us diversify. Attractive returns, obviously, we harped upon this quite nicely, and I think majority of my panelists have really, highlighted this capital preservation. I think this is the number one rule that Vino lives and dies by at Terra Equity Group, is basically preserving the capital for investors. And in order to do that, we have to ensure, and we do, that the assets that we are going into are basically, we're going to have an upside waiting for us as we exit, and particularly even when we go into those assets, hence the distressed properties and the opportunistic fund here. So next slide, please. Oh, go ahead, Vino.
I was just saying, another is our regular investor can be invest side by side with the big funds that we bring in from family offices and pension fund and everything. So this fund will really going to create a big value for bigger partners and smaller investors. They're going to be, investing side by side with the, family offices and pension funds and etc.
Perfect. Strategy overview. So I'll touch upon that a little bit, unless Vino, you want to go through that.
No, go ahead. Puneet.
Okay, so we're purchasing 6 to 12 distressed real estate assets inside the fund. That's our goal. We want to effectively manage and increase the net operating income of those assets. Primarily, as our secret sauce or formula is reducing expenses, increasing rents, and adding value. Distribute regular cash flow throughout the holding period, which is anywhere from 4 to 7 years or 5 to 7 years. We're going to be doing quarterly distributions, and the hold would be until we exit the assets. Next slide, please. Why a fund? So talk a little bit and touch upon that as well. Diversification. We've beat that one to death. I think it's a huge driver as to why we want to go in a fund. The second piece is you're not vested in a single asset. It's if maybe one particular asset is outperforming the other one, it can pick up the slack for the other one, right? Stabilized returns. So diversifying again stabilizes your returns and provides a great blended return in these type of funds. And so as a highlight, as this basically slide is highlighting, a single asset syndication, basically it's deploying capital into a single asset. Unlike what we're doing here, we have a fund is simply a multi-asset approach. All right, we go after multiple assets in that same fund, and the idea is that diversification is going to help leverage the risks associated in with investing in real estate. And then the other thing is the funds are in this particular fund, we're not only diversifying across multiple assets, but we're also going after different markets as well. So, and which in turn also helps stabilize the returns and minimizes that risk that you inherently see with a single asset. So, so is the fund right for you? So Karan, can you talk a little bit about that one?
Yeah, absolutely. So if you want to decide whether or not this fund is right for you, there's really a couple of key components that we're looking for. The first is, as mentioned before, an accredited investor. Second, cash flow focus. That's a priority either in the A2 or A1 criteria. We want to make sure that the investment is a cash flowing one. We want to make sure that that's the focus of yours. The third is a flexible exit timeline. As we've discussed, market conditions change throughout. So we want to really target the best possible exit opportunity that we can. And that happens, and that can change depending on the market. We want to know if you're seeking to limit your single asset risk and achieve geographical diversification. I know we've touched on diversification a lot, and that goes across different areas, different asset classes, all of that. If you're looking for an investment managed by a team of experienced and proven industry veterans, so we have that here at Terra Equity Group. And then the last one is if you're fun and easy to work with. We want to make sure that this is as stress-free of an investment as you can make. So we want to make sure that that's something that, we're easily able to work together on. So I'm going to hand that back over to Puneet.
Okay. So all great points there, Raj. If you could talk a little bit about the critical dates, what they mean for our investors here today. And then we can certainly, after that, as we near the end of the webinar, we'll do a little bit of dialogue between the panelists, and then we can certainly open it up to some Q&A out there.
Sure. So due to our long history in properties, we have a decent investor base that's incredibly interested in the fund. And, due to that, we have strong investor demand, and we're switching to a first fund, first serve model. This means if you are interested and this fund is something that you want to be a part of, we'll need to fund your investment immediately following, your commitment. And your commitment is only secured once we have the funds. Terra Capital Income Fund will be open for investments beginning April 15th, 2024. And I think that's the critical dates. And we commit. If you are in, log into our investor portal or create an account. To access the portal, navigate to terraequitygroup.com and click investor login. This is where you will make your commitment, e-sign offering, and get updates about your investment. Second is the documents. We encourage you review and complete all of the legal documents that are inside the portal. Third step is accredited investor verification. We'll need the proof that you are an accredited investor, and we need that by obtaining a third-party verification letter. And then the fourth step and the final step is the funding. Once you complete the necessary steps, you're ready to fund the deal. You can either link your bank account for ACH transactions or view the wire instructions. And, you can always schedule a advisory session with us. Give us a call, 954-987-6879, or send us an email, info@terraequity.com. And we can schedule a 15-minute free advisory session to talk you through any questions you may have. And if anybody has any questions, feel free to ask them now too.
Perfect. So we'll kind of open up the Q&A as those questions are popping in. I want to kind of highlight some of the, high-level points in regards to the fund, the timing of our capital markets and the economic cycle that we are in has certainly created a great opportunity to go after some of these distressed assets and be a part of that. And I think there's a lot of returns to be made, and that's why we are launching this fund. Vino, our CEO and founder, is in the driver's seat. He has navigated through some of these, at least the three of these downturns. So certainly very well versed and experienced with these situations and how to weather these storms and what opportunities to look for in times like these and how we can use that to our advantage. So certainly great points there. We have a great team that's driving the results here, a great asset management team, fund management, wide array of expertise on hand with our team that can certainly handle and navigate these times to really create some opportunity and great returns for our investors. And lastly, the track record that we have here at Terra Equity Group, that certainly speaks volume for itself. And Vino, I want to we got one question here that we're going to get to, and before we get to that, I just want to kind of throw it back at you and see, do you have any questions in regards, or actually not questions, but anything that I may have missed and not touched upon? And then we'll kind of go down our panelists and see if they would like to add some last parting bits. But you go first and we'll answer some questions. Vino,
Yes.
anything I missed that you want to add?
Well, only thing I wanted to tell our investors that we have at this moment, like almost 500 people join us on this webinar, and we will be raising these funds throughout the world. So, if you liking what you're hearing and you wanted to take advantage of this fund, then you got to quickly join. We will be, starting this fund on April 15th. And we picked that date because of the tax season. We said, okay, this April 15 is the right day to start these funds. And we're taking funds from family offices, pension funds, and individuals like yourself. So any questions, I'll be more than happy to answer.
Perfect. So on that note, we have a question Paul is asking. What are the tax advantages of investing in a fund like this? I know for a single asset syndication, we could do cost segregation studies and benefit from depreciation. How does that work here? Do you want to jump on that?
It's going to work the same way it works on a single asset. It's going to work on multiple assets, and they still get participation on multiple asset advantage on the tax. We still will be doing as cost segregation and everything else.
Perfect. Right after that, we have a question by Neil. Neil is asking, can you give an example of what a distressed property actually looks like? Is it a poorly managed apartment building with low occupancy or something else? So talk to us in regards to that. So draw some clarity and some color into what a distressed asset looks like or investment.
There are a couple of characteristics of distressed property. It could be mismanagement. The property still could be a 95% occupied, but they're not managing properly. Is overfunded property that initially when the interest rates were low, they were overfunded, and now they can't support the cash flow to pay for the mortgages and their obligations. So property could still be 95% occupied, but the deal is not making sense for them. At that moment, the deal is a losing deal for the investor and for the lender. So the lender might take less money and pass on to the deal to somebody else who can manage properly. And that's where we come in the picture. We have seen deals, trading from 50% discount to 40% discount to 60%, like different categories. But what we will be looking at is a market, what place that is, how new is the asset is. After we reviewing hundreds of assets, we will plan to buy one or two out of those distressed assets. So we're not going to be rushing on anything. We're just going to be really analyzing how does that fills our portfolio and how our investor is going to have a cash flow and upside on these properties. So we will be reviewing these things. So there could be different characteristics on the default side.
Okay. The following question is by Sheila. Sheila is asking, you talk about geographic risk mitigation, but your company's focus is primarily in the Southeast. Is the fund also intended to invest only in the Southeast United States? So,
well, first one is we will be investing in the areas that we are already familiar with, because you need to know your market. So if you know your market and you can create the value there. Another criteria we use is where the population growth is, where the job growth is, and location of the property. We will be buying in a B or A class assets, more precisely A class assets in the A class neighborhood, where there's no shortage of running the property in the best way. So yes. Now, if we really have a deal that's going to be 20 cents on a dollar, of course, we'll look up other market, but primarily the market that we are familiar with.
I had myself on mute. Okay, perfect. Lastly, Paul is asking, again, follow-up question. can you remind us again, what's the total raise for the fund? First question. Then he has a follow-up question, which is what happens to the amount of money committed and invested by investors while we're still looking to acquire or raise remaining funds? So I think two great questions there. So, if you want to jump
Well,
on
the
those.
total fund is $100 million, and we are going after like family offices. Some family offices has shown the interest, so we are expecting the fund to deploy quickly in the fund. And if we are taking funds and we can buy one property, we will start with it. We're not hold until we pick up all 7 properties. It just completely depends on, how much money has committed and how much money have came in, and we will start buying properties real quick.
Perfect. All right. Now I would like to go back to my 2 other panelists and see if I may have missed or any last parting words they would like to add. So I'll go to Karan first, and then Virat. So Karan, give me your, summary or anything we may have missed that you'd like to add.
Right, so I just want to kind of piggyback on that. Nothing new to add, but do want to stress the importance of acting quickly for this offering. It's a very exciting offering. We already have a lot of interest in it, and if it's something that you're interested in, I urge you and encourage you to reach out.
Perfect. Raj.
For me, I'd just like to add, we'd love to have you a part of our family, and we look forward to growing with you and growing together and influencing and being a good influence on the communities and creating a better environment for our tenants. So that's all I would like to add.
Perfect. And lastly, Vino, if I may have missed anything or what you may have, if you have any thoughts you'd like to share before we end for tonight.
So again, just let us know if you wanted to talk about the fund, you want to get on the phone call or schedule a call. We're here, and answer all your questions, which you may have.
Perfect. And right on cue, I don't see any other questions, so I'll wrap this up. I once again want to thank you all for joining us here at Terra Equity Group. Certainly appreciate your time. And as my colleagues shared with you, time is of the essence. We have a lot of interest being generated with this fund, and we certainly want to urge you that if this is something that piques your interest, do not sit and wait. Act on it. Reach out to us. We have multiple ways of you connecting with us: phone number, email, website, and what have you. So, with that being said, looking forward to chatting with you. Some of you on the other side, and looking to answer any other questions that may come outside of this webinar. And once again, we want to thank you for the opportunity, and thank you all for joining us on behalf of Terra Equity Group, as we wish you all great evening.